Well, sure does look like we got some major deflation coming. I'm over here right now at Zero Hedge, and I'm taking a look at a quick article about global excess liquidity collapsing. Here's the thing. Unless the Fed decides to stop with these interest rate hikes in this game of Jenga that I was talking about, and if you know, about 2 episodes ago I did a show, and I related what the Fed is doing to a game of Jenga where they're pulling out the blocks. Each subsequent rate hike is making the tower more likely to fall. In other words, the world economy. They're increasing the pressure with each rate hike. Well, unless they stop this, unless they put an end to it in reverse direction, the whole thing's going to come crashing down. And very soon. And what this is going to yield is it's going to yield a very sharp deflationary period. Now, there's 2 men that have been saying this is coming. One is Harry Dent, and the other one's David Stockman. And they're going to be proven right if this continues, and if the Fed keeps up this, what the Fed's doing with this hawkish stance that they have. Now, when these guys are proven right, at first you're going to think, hey, you know, these guys really, they nailed it, and everybody else didn't. And everybody that said, they're going to think that everybody that said hyperinflation was wrong. It's actually deflation. But in truth, it's this deflation that's going to lead to the hyperinflation. Now let me explain for a minute. The Federal Reserve is causing this deflation. If they stopped in reverse direction right now, the stock market will go way up. The stock market has room to go up. Honestly, it does. If conditions were changed. But because they're tightening, and they're going to be tightening soon all over. The Bank of Japan, the ECB, everybody's going to be tightening soon, along with the Fed. It's almost like they're coordinating themselves to bring the system down. And in fact, I think that's what they're doing. I'm suspicious that that's what they're doing. I don't really have any proof that that's what they're doing. It's just what it looks like to me that's what they're doing anyway. So I might as well, if you don't have any proof, you might as well not talk about that particularly, that they're doing that on purpose. But that's almost what it looks like, because that's going to be the end result, is they're going to bring the system down in a deflationary spiral. Now, I can tell you something right up front before I read a little bit of this article. If they start a deflationary spiral, it's going to look at first like Harry Dent and David Stockman are correct. But ultimately, they're not going to allow that to continue. They can't possibly allow it to continue. So they're going to react to it. And it's that reaction that is going to create the big inflation. So I call that reaction. I call it the Great Print. Anyway, let's read a little bit of this article. It says the next leg is clearly lower. Global excess liquidity collapses. This is actually a sign of deflation. And that's what I'm saying, but I'm going to go back to reading the article. It says, first it was Citi Hans Lorenz warning about the threat of growing global risk assets as a result of the upcoming slowdown in global central bank balance sheet growth. Then yesterday it was Matt King's turn to caution that the Fed's hawkishness this week adds to the likelihood that in markets a significant unbalancing, or perhaps that should be rebalancing, is coming. It is said that both the ECB and the Bank of Japan is injecting hundreds of billions of dollars each month, even as they are set to run out of haven assets. Well, the thing is the ECB and the Bank of Japan, what they're doing is they're buying these bonds, and that releases the money. And the thing is they're running out of bonds to buy, both of them. And I think that's what he's talking about here. He says, even as they are set to run out of haven assets. He's putting it in quotations, haven assets. This is kind of I think a little bit of a pun, saying that they're haven assets when the people really are putting their money in these treasuries, and they're going to be worthless because who's going to buy them? When the central banks quit buying them, who's going to buy these things? So they call them haven assets. The real haven asset is the silver and gold, which they don't want. Not right now anyway. They're all frightened of it. So let's read on. It says, in the coming year, there is still time before the global central bank's balance sheet's tipping point is reached and assets roll over. Now, see, he's talking about these safe haven assets before they roll over. And I agree with this wholeheartedly, but this is going to cause a major depression. Not just a recession. What we're looking at coming is a depression. It's going to be such a severe depression that they're not going to be able to deny it's a depression. They're not going to be able to say, oh, we're in a recession. It's going to be so severe, they're going to have to actually use the D word, depression. Okay? Now, that's my point on it. Anyway, let's move down here a little bit further. It says, although last week we flagged a more immediate problem for credit and thus liquidity in the United States, we showed that even though the United States is reportedly growing at a comfortable rate, and see, that word is reportedly growing at a comfortable rate. I don't think they're growing at all. They're listing it as quarter 2 GDP rising 2.9%. Loan and growth in the United States is just weeks away from contracting for the first time since the financial crisis. So see, this is the trouble. This contraction is your deflation. And this is the first time since the financial crisis. Now, the Fed's been just tightening it long enough for this contraction to come. Their tightening policies. It's just been tightening long enough for the contraction to come. And when the contraction comes, it's going to be swift and sudden, and it's going to be major, and they're not going to be able to stop it. See? To reverse the direction, it's going to take a tremendous amount of stimulus, and that would destroy the dollar. And so anyway, let's read on. It says, such inversions have traditionally taken place when the United States economy was already in or about to enter a recession. Yes, also, the yield curve is inverting. That's a sign of a recession coming as well. So, it says here, as a reminder, whether androgynous or exogenesis, I have trouble pronouncing them. Basically what it means is inside or outside. So I'll say inside or outside. As a reminder, whether outside or inside liquidity has to be created somehow. Liquidity being money. So basically, I don't know why he's using such complicated words here, but what they're saying is, as a reminder, whether outside money or inside money is to be created somehow, either through loan creation by commercial banks or reserve creation by central banks, for growth to persist and to keep asset prices elevated. So in other words, he says, I'm going to break it down for you, what he just said. What he just said is, in order to keep the blowing the bubble up, you got to keep putting air into the bubble. In other words, liquidity, which is money. In other words, this bubble is made out of money. Money's like the air in a balloon. And in order to keep the balloon pumped up, you have to keep pumping the air in. Otherwise, the thing's going to go flat. I mean, that's just simple logic. And the Fed, their tightening program is basically them just not putting any more money in. They've been hauling money out. And now by wanting to sell their balance sheet, they're really wanting to pop the bubble. And by raising interest rates, they're going to pop this bubble. Like I say, if they keep going, unless they turn around now, we're heading toward deflation directly ahead. It's like it's like going down Niagara Falls, and I can hear the falls right here in my ear. I'm like, I can hear the roar of it. And I said, boys, our boat's drifting toward the falls. Right now, that's what's going on. It says, the moment the process, he's talking about, of adding liquidity, slows down, halts, or reverses, that's when the equilibrium phase shift, a recession or a depression or market crashes occur. More on that in a subsequent topic. So continuing these observations overnight, it was Deutsche Bank's turn to warn about the deterioration in the credit creation. Or as Deutsche Bank's Dominic Konstam calls it, excess liquidity. The first introduction by JPM Bank, okay, that's a note there. It says, which, he writes, continues to weaken in the United States. In other words, the excess liquidity that's been sloshing around in the system is drying up fast now in the United States. In other words, the bubble's starting to deflate. And when bubbles pop, they pop fast. They don't pop slow. As a result, the output momentum, or simply stated growth, is still weakening. And an analyst conducted by the Deutsche Bank credit strategist summarized it by saying 6 charts at the bottom. He finds evidence of further softening in the PMI data and notes that we continue to view softer inflation as a preferable remedy for weak excess liquidity rather than deeper declines in the output growth or tumbling stock prices, perhaps. He summarizes this mix in the spirit of falling price boom, where weaker inflation supports real growth as purchasing power is restored, although in the same time this transitionary deflationary impulse leads to the threat of an even greater buildup of sustainable debt, as has been the case for the past 8 years. Here's what Constam's explanation on what the slowdown in excess liquidity means for the world economy and markets. We have updated our yield momentum measures to highlight that as an output momentum rolls over, even if yield remains unchanged, here it will still take a few months to see yield momentum falling back to zero in the very near term, suggesting yield momentum is too high. We see this as consistent with our bias that the best yields remain broadly unchanged, but at worst in the near term. There is a downside potential. This relies on the analyst to show output momentum turning point are closely tied to shift in yield momentum. Here we are using 5Y, 5Y, G3 yields versus a year ago. In sum, the latest data for excess liquidity framework does not lead us to change our view that yields can quite easily trade below 2% in the 10s for the US and closer to 2.5% for the 5s. So what he's saying here is that the 2% that they can trade below 2% for the 10-year bonds, and evidently in 2.5% for the 5 years. So that would be an inverted yield curve, I think is what he's talking about here. Finally, showing the critical role of excess liquidity in this context through loan creation, or the lack thereof, Deutsche Bank presents the following 6 charts showing their impact on everything from global momentum to inflation to sentiment surveys such as the PMIs. What is clear is the next leg in both regional and global economies is clearly lower. Yeah, it could be an extremely amount lower. I mean, this whole thing is setting up for a drying up, a sudden drying up of all of the liquidity or all the money in the system. And this is what suddenly happened. This doesn't happen slowly. It leads up to it happening. And most people are unaware of it coming until it hits. And when it hits like 2008. Except this time, this is going to be potentially worse than 2008. And there's more at stake. There's more of everything. They've inflated everything more than in 2008. And then they don't have anything to fix it with. 2008, they could lower interest rates and they could come in with stimulus without destroying the dollar. Now they've taken away all these options. They don't have any options so much anymore without destroying the dollar. That's the only option left to them. They just can't let this thing go unchecked. In 2008, did they let it go unchecked? When it happened, when we had this contraction in 2008, a very steep contraction, they said, okay, if we let this thing go, the whole system's going to freeze. And they knew that's true. So when we get this steep contraction again, a steep sudden contraction, the contraction that Harry Dent and David Stockman's been pointing out, right? It's going to hit, but it's going to be very short-lived. Harry Dent and David Stockman's only going to have maybe a few weeks to rejoice and jump up and down and say, oh, we told everybody, we told you it was coming. You know, during that 2 or 3 week, probably maybe 3 weeks period. But at the same time, it's going to be in all the newspapers. It's going to be, the banks will be closing. You'll go to the ATM to get your money and it won't be there. What money will be worth will be shooting up because everybody's going to want dollars when this thing hits, and there's going to be no liquidity around anywhere. People are likely to start, this is going to be worse than 2008 because the people are going to feel it this time. Back in 2008, they come rushing in so quick that you didn't really get a chance to actually feel it. It didn't stick you in the arse like a pin sticking you in the bum. This time, it's going to stick you right in the bum. You're going to go in to use your what you're used to going in. You're used to going into the grocery store and sliding that little card through the machine, or running that little card across the top of the machine. It goes beep, or you have to put your numbers in. I don't know. It depends on how new your bank is and how new your cards are. Right? The newer ones, they just go beep and they got you without even sticking a pin, I don't think, in. So anyway, you're going to have to do those. You're going to go to the grocery store to use that thing, and they're just going to tell you at the grocery store, we're only taking cash today. That's what's going to happen. And you're going to be like, what? And all the people are going to be upset. They're going to be like, we don't have any cash. And my one woman's going to yell in the back of the line, my baby needs baby formula. You know? And she's going to say, I don't have any cash. All I get's this card. Going to be waving her card over her head. Let me use my card. And, you know, and all this stuff. People are going to be crying and crying and about this. And nobody's going to have any cash. So the immediate reaction is that the value of cash is going to shoot upwards very quickly, because the grocery stores then aren't going to be able to sell their merchandise, and they're going to start dropping prices on them almost immediately in the store, especially on things that are perishable, like their meat section and their and it's just going to be, you're going to see stickers all over their meat, 50% off today only, you know, stickers, and a lot of it's going to have to go out in the bin, and because it's going to get old on them, they're not going to be able to sell it because nobody's going to be able to buy it, because they're all going to have their credit card, but the credit card ain't going to work, and only cash. And so this is going to create a huge problem, immediate Russian problem, and the people are going to turn to the government. How are you going to solve this? There's probably going to be riots, and they're going to put a tremendous pressure on the government to solve it. So it's only going to last a few weeks. And then what's going to happen is the government's going to come out and they're going to stand in front of the podium and they're going to wave their hands. We got this under control. That's what's going to happen. And they're going to pump the liquidity in like you've never seen liquidity pump before. Now, I'm going to tell you what. They're going to use helicopter money too. And it's going to be quantitative easing times 4. And it's going to be dropping the interest rate back down to 0 or even in the negative territory. And as soon as they do that, as soon as they open those floodgates, then what David and Stockman and what Harry Dent have preached all this time, it's going to be the end of what it's got. That's suddenly going to come to an end. What they're being right, and then it's going to change. It's going to change to other economists who have been preaching hyperinflation being right. Because as soon as you get that money from the Fed, it's that help money that they're going to send out, the helicopter money, you don't walk to the store, run to the store, because the prices are going to shoot in the opposite direction. Like for days, the prices have been dropping, 50% off meat, you know, like I said, you know, dropping prices in the grocery stores, dropping prices on other things too, like cars and everything. They'll be wanting to move stuff, right? But all of a sudden, when the helicopter money hits and the government goes to change direction, then you're going to see everything reverse. And I'll tell you who's right. You're going to find out who's right. And I know a lot of you guys have bad-mouthed Mike Maloney. But I'm going to tell you, he's a charting genius when it comes to charts. And Mike Maloney knows a thing or two, and he's been preaching for a long time about this coming deflationary period that's going to lead to the hyperinflation. And I'm going to tell you, he's going to be proven to be right in the end, because that's the way it's really going to go. It's going to go into this deflationary period that's going to lead to the hyperinflation when the government reacts. And this is what you got to go through, and it's going to be tough, boys. It's going to be tough. But as soon as those floodgates of money open up, run into the grocery store and spend that cash you got, and before the prices go to the moon. And that's when this gold and silver is going to finally take off like nothing you've ever seen before in price. But the problem is this is going to be the rally when you don't sell. You heard me right. It's probably going to be the rally when you actually do not sell. You watch the price go up daily. Unbelievable how high the price could go on the stuff, gold and silver. But when you're seeing the price go up daily, this would be the rally you don't sell on. Because if you sell, no matter where you think the top is, it could go higher. I mean, if we're heading into a hyperinflation, what actually could the upper end of the price go to? I mean, on something that's real. If everybody wants to get out of something that's not real, and they're begging you to buy the stuff that's real, because they know that their ship is sinking. I mean, it doesn't matter if you've got the most beautiful ship on earth. If you've got the Titanic, she was a beautiful ship. She had marble floors, and she had gold. There was things were laced with gold and everything. It's just the most gorgeous ship you ever seen, and they were so proud of her. She's unsinkable and all this kind of stuff. Well, that's what they're saying about the U.S. dollar, unsinkable, right? And it'll never go down and all this kind of stuff. Well, the thing about it is, she can be the most beautiful ship in the world, but if that ship is sinking, it's no use staying on it. You're going to want to get off, and that's what they're going to be with the dollar. That ship's going to be sinking. They're going to want to get off. And the other way with gold and silver, or even with the cryptocurrencies, is going to be going up endlessly. And they're going to be wanting to get onto something that's going up and get off of something that's going down. And they'll be begging to get the guy might come, and you might have just a little coin or something made out of silver or something, and he'll be begging to buy it at any price to get you into his dollars that's going down, and then he can get into something that's going the opposite way, going up, because nobody wants to sink with it. And the problem is there's going to be so much of it, and they're all going to be sinking with it, because 99% of the people do not own anything that's going to go in the opposite direction when the dollar goes down. They're so heavily invested in the dollar. Dollar is king, and they've trusted the banks so much. They put so much faith in the banks. The banks. But you know, if you went back and asked your great-grandfather or your grandfather about the banks, he would tell you what the banks did to you back in the Great Depression. He would tell you how they screwed everyone over, and how they didn't care. They laughed about it. And he would say, don't trust the banks, your grandfather. But the banks came along later, and they opened up these savings and loan and trust. They called it savings and loan and trust. In other words, trust us. Trust us with your money. This is a loan and trust. A trust. And they're going to want you to trust them. And this is what they want you to trust them. And they were good for all those years, 1932, all the way up. They've been awful good, you know. They've kept your money safe and everything else. You know what I mean? And the people trust them. The people trust them. But when they screw you over, they're all going to screw you over simultaneously at the same time. This is what they're going to do. And this is what they did back in that made your grandfather not trust them. Or your great-grandfather not trust them. But we've all forgotten what they did. We've all forgotten what crooks they really are. So listen, thank you very much for listening. Like and subscribe, and hey, we'll catch you in the next article. Bye.